There was a time years ago when the only people able to trade actively in the stock market were those working for large financial institutions, brokerages, and trading houses. The arrival of online trading, along with instantaneous dissemination of news, has leveled the playing, or should we say trading field. The easy-to-use trading apps and 0% commissions of services like Robinhood, TD Ameritrade and Webull have made it easier than ever for retail investors to attempt to trade like the pros. Day trading can turn into a lucrative career, as long as you do it properly. But it can be challenging for novices, especially those who don't have a well-planned strategy. And be aware that even the most seasoned day traders can hit rough patches and experience losses. Welcome to Gig Finance, where our goal is to provide short, engaging video content related to finances that will educate and motivate you to become a better investor and more financially stable. Today's topic is day trading for beginners. So, what exactly is day trading and how does it work? Day trading is a fast-paced form of investing, where individuals buy and sell securities within the same trading day. The primary goal is to profit from short-term price movements in stocks, options, futures, and other financial instruments. Day traders typically use a combination of strategies and analysis, including technical analysis, which focuses on past price movements and trading patterns, and momentum, which involves capitalizing on short-term trends and reversals. Unlike long-term investors, day traders are less concerned with the fundamental value of the securities and more focused on capturing immediate gains from market fluctuations. The appeal of day trading lies in its potential for quick gains, but it's also associated with significant risks. It requires a solid understanding of the markets and the ability to make fast, informed decisions. Day traders need to stay abreast of market headlines, economic reports, and other factors that can influence stock prices throughout the day. They often employ leverage, borrowing money that can increase both potential profits and potential losses. As such, day trading is generally not recommended for inexperienced traders or those without the financial capacity to absorb losses. It is also important to understand the regulatory environment around day trading. In the United States, the Financial Industry Regulatory Authority, FINRA, and the Securities and Exchange Commission, SEC, set margin rules only in margin accounts for pattern day traders, defined as those who execute 4 or more day trades within 5 business days. These traders must maintain a minimum cash balance of $25,000 in their brokerage account. For those who don't have at least $25,000 in their brokerage account, the only way around this rule is to limit your day trading to 4 day trades per business week or less, or to hold the stock until the next day before selling. Most of these day traders may wait to buy a stock until the last hours of the market, between 3 and 4 o'clock p.m. Eastern Time. Day trading is most commonly observed in the stock markets and on the foreign exchange, Forex, where currencies are traded. Day traders are attuned to events that cause short-term market moves. Trading based on the news is one popular technique. Scheduled announcements like releasing economic statistics, corporate earnings, or interest rate changes are subject to market expectations and market psychology. That is, markets react when those expectations are unmet or exceeded, usually with sudden, significant moves that can benefit day traders. A trader needs to have an edge over the rest of the market. Day traders use any of a number of strategies, including swing trading, arbitrage, and trading news. They refine these strategies until they produce consistent profits and limit their losses. There also are some basic rules of day trading that are wise to follow. Pick your trading choices wisely, plan your entry and exit points in advance and stick to the plan. Identify patterns in the trading activities of your choices in advance. Day traders use numerous intraday strategies. These strategies include scalping. This strategy focuses on making many small profits on ephemeral price changes that occur throughout the day. Arbitrage is a type of scalping that seeks to profit from correcting perceived mispricings in the market. Range swing trading. This strategy uses predetermined support and resistance levels in prices to determine the trader's buy and sell decisions. News-based trading. This strategy seizes trading prospects from the heightened volatility that occurs around news events or headlines as they come out. One type of news-based trading involves whether a merger or acquisition that has been announced will go through or not. High-frequency trading. These strategies use sophisticated algorithms to exploit small or short-term market inefficiencies. Individual traders often manage other people's money or simply trade with their own. Few have access to a trading desk, but they often have strong ties to a brokerage due to the large amounts they spend on commissions and access to other resources. However, the limited scope of these resources prevents them from competing directly with institutional day traders. Instead, they are forced to take more risks. Individual traders typically day trade using technical analysis and swing trades combined with some leverage to generate adequate profits on small price movements in highly liquid stocks. For the average investor, day trading can be a daunting proposition because of the number of risks involved. The US Securities and Exchange Commission, SEC, highlights some of the risks of day trading, which are summarized below. Be prepared to suffer severe financial losses. Day traders typically suffer severe financial losses in their first months of trading, and many never make a profit. Day trading is an extremely stressful full-time job. Watching dozens of ticker quotes and price fluctuations to spot fleeting market trends demands great concentration. Day traders depend heavily on borrowing money. Day trading strategies use the leverage of borrowed money to make profits. Many day traders not only lose all of their own money, they wind up in debt. Don't believe claims of easy profits. Watch out for hot tips and expert advice from newsletters and websites catering to day traders. And remember that educational seminars and classes about day trading may not be objective. If you're determined to start day trading, be prepared to commit to the following steps. Make sure you come in with some knowledge of the trading world and a good idea of your risk tolerance, capital and goals. Be prepared to put in the time to practice and perfect your strategies. Start small, focus on a few stocks rather than wearing yourself thin. Going all out will complicate your trading strategy and can mean big losses. Stay cool and try to keep emotion out of your trades. Don't deviate from your plan. If you follow these simple guidelines, you may be headed for a sustainable career in day trading. Day traders can earn big profits or pile up significant losses. Indeed, with the evidence showing that most day traders lose money over time, it's an extremely risky career choice. Day traders, both institutional and individual, would argue that they play an essential role in the marketplace by keeping the markets efficient and liquid. Though day trading will always be intriguing to individual investors, anyone considering it needs to acquire the knowledge, the resources, and the cash that it takes to have a chance at succeeding. In closing, let's cover some rules for beginners. 1. For starters, only make 4 trades per business week or less in order to not be flagged as a pattern day trader. The only way around this is to buy stocks at the end of the market day and sell the very next day. Trading in this way may also be considered overnight trading. 2. Never borrow money to trade or use margin until you are a well-experienced trader. This will significantly help you out of falling into debt on bad trades. And 3. Never invest more than you are willing to lose. Beginning day traders can start out with as little as $1, slowly taking small profits and working their way up the ladder. Many day traders start off investing in penny stocks with very little money. Thank you for watching. Don't forget to like this video and subscribe to this channel. This is the only way that we can make sure you are getting all of our up-to-date content.